Welcome in. My name is Arya, and I don't waste your time, so let's get straight into it. The markets are in turmoil. There's no way to beat around it. Stock market's crashing. The S&P's down, I think, close to 20% year to date. And things are horrible. There's no discounting that. And at the time of this recording, actually, we had our first sort of green day yesterday, since markets start to crash, and the S&P was down like 11%. So I thought it would be a pretty interesting video idea to kind of do for first of all, like a transparent portfolio update. Like, I'm also losing money. This is not some sort of crash where I've magically somehow hedged and I decided to sell everything at the perfect time and I haven't lost. No, I've also been underperforming the market. I've also been losing money. So we'll go through that, the portfolio update, what I'm kind of thinking through with all the different companies and that type of stuff. But at the same time, a sort of time capsule to maybe perhaps look at this at some point in the future, maybe do a reaction video of this a year down the line and sort of track the progress of that over time, because I have a hunch that this sell-off is not going to continue. I think you'll have a lot of speculation with the sort of tariff stuff at the moment, and the markets are crashing and whatnot, and everything's going down to very silly valuations in my opinion. But I think it's just a product of uncertainty, and of course we'll sort of get into that. So to kind of set the stage, actually, we should probably start off with why the markets are selling off. And so for reference, I'll just pull up the Fear and Greed Index, which, it's not the perfect representation of the market, but at the moment it currently is at a 5, which, if you're familiar with this at all, this is one of the lowest readings over the past decades, perhaps, right? Like at the bottom of 2008, I think it reached, I want to say off memory, I think it reached about 8. And then at the bottom of COVID, I think it was like a 2 or like a 4, something ridiculous, right? So in terms of fear, this is like peak fear. Doesn't get worse than this, right? So earlier this year, we had the Japanese stock market crashing, and they started increasing interest rates. And so August 5th, we hit extreme fear of about 17, 18 on the fear and greed. Currently, we are leaps and bounds lower than that, right? And then in terms of the S&P, if we just simply pull that up, you're able to see that on a year-to-date basis, we're down about 14%. But I think since the all-time highs, we're down a little bit more. I think we're down about close to 20% since the all-time highs, right? And by the way, it's only been since halfway through February that we hit all-time highs, I believe. So like it's 6-7 weeks that the market has lost 20% of its market cap in. And so of course, with the S&P being down, naturally all the Mag 7 stocks are going to be down, the same amount or even more. You have Meta and Microsoft, which are like only down 14%, but everything else is down more than 20%. And in the case of Tesla, it's negative 40%, which is just absolutely ridiculous, right? So all of this because Trump announced the tariffs, I think roughly a week ago. And ultimately, I'm not some macroeconomic expert, but in my opinion, I think it's a lot bigger of an issue, and all these companies are getting re-rated and going down just purely based off of it's way too uncertain of a market. I think that's the biggest issue, is like the market can't decide whether or not this is actually tariffs that are going to be staying, or it's like the negotiation tactic or whatever. Again, I'm absolutely no expert at this type of stuff, but I guess the point of this video, or the point of this segment altogether, is like, you look at, like, for example, in the 2018 timeframe, we had basically the exact same thing happen. And if we go over to the S&P, we do drawdowns feature. Let's extend this out to like 2018-ish. Here we go. And you basically had the exact same drawdown in 2018, where it went down about 18-20% or so. That was, again, as a result of Trump, quote unquote, starting a trade war with China. In the span of about 100 days, the S&P declined 20%. Obviously, this one was a much faster of a crash. Again, from mid-February to now, 6-7 weeks is not that much time. But the point is, you could imagine the guy at the bottom here, and I'm not saying we're at the bottom, by the way, but I'm saying the guy at the bottom here in 2018 is probably looking at the market like, oh no, it's going to get worse. And it's always going to look scary when we're in the midst of a drawdown. But I mean, any of you could just toggle on the S&P's long-term price chart, and you're very easily able to see, like, a lot of these drawdowns and sell-offs and that type of stuff, they happen, but over the extremely long term, which I'm assuming if you're watching a channel like this, you're a long-term oriented investor, things are going to improve. It looks really scary at the moment. Fear and greed's at 5. We're going into earnings season now, and all the CEOs are going to get on their conference call and talking about, yeah, the tariffs are going to materially impact us, and we're revising lower in anticipation of tariffs and all this stuff. So things are not going to be easy, but I would argue this is where it goes back to you and your personality as an investor. You have to kind of balance out the two sides of, like, there's always going to be the fundamentals and the research, and you being able to do the qualitative research and understand that, it's a good business, for example, that you're interested in buying in. And then I would argue the other 50% of it is what you do afterwards, the portfolio management side of things, the emotional side of things. In the event of a sell-off like this, things are very gloomy. You open up Twitter today, or open up Twitter over the past week, really, people have been calling for like the Great Depression, or at least that's what it feels like. And so ultimately, what you have to sort of do in situations like this is stick to your guns. This is very, very almost certainly it's going to be a sort of temporary thing. Like I said, in the 2008 period, this was only a 100-day sell-off, and then we were back off to the races. Even during COVID, when the market crashed 30%, was that for like a month? And then it was back. 2022, admittedly, it took the full year, whatever, right? But the point is, all these sell-offs, this is like just normal behavior. These sell-offs are supposed to happen every couple of years, and it is what it is. Ultimately, as long as you're buying all-weather quality businesses that are able to come out the other side of these sell-offs and these tough macro environments stronger as a business, there's no reason you should be worried. You should be actually excited to buy more into these companies, right? And so anyways, enough with the sort of pep talk and basically just stick to your guns. Let's dive into my portfolio and how much I'm down. So I track my portfolio over on, I'm not affiliated with the software at all, by the way, but Snowball Analytics, and I basically put in all my trades manually into this over the past however many years. And there's two sort of ways where you could track the performance. You could track the total absolute value of the portfolio trading up or down. And then you could also track the IRR, or the internal rate of return. That's more of like a time-weighted thing, right? So this is on IRR view, which is time-weighted. And on this view, I'm only down about 13% year to date. But then if we switch this over to a total profit percentage view, you could see that I'm down about 17% year to date. And this compares to 30% up last year, 50. This doesn't include impact of cash, by the way. I should mention that as well. So excluding the impact of cash, just how much my holdings were worth versus how much they're worth now, right? So it's negative 17% year to date. And then in terms of IRR, it's negative 13%, right? So it's because it's time weighted and I was buying more recently and that type of stuff, it's down a little bit more. But I mean, you compare this to the NASDAQ, the NASDAQ's basically the same thing, right? So had I bought the NASDAQ, actually I would be losing a little bit more money. And it makes sense, right? I have a very concentrated portfolio of basically just big tech. I have Amazon, Google, and then ASML and Uber are also very tech heavy businesses, I guess you could call them, right? So I'm probably going to track the NASDAQ pretty closely, especially during periods of the market going down, right? But I mean, for me personally, nothing really changes with any of these businesses. It's not like all of a sudden Amazon has lost the dominance that it has with AWS. I'm generally very unemotional when it comes to stuff like this. I invested in these companies for the next 5, 10, 15 years, particularly with the two cloud businesses. I bought into those two businesses in particular for literally the next decade plus. And so as of right now, I'm absolutely not worried in terms of, the stock is down, so maybe my thesis changed. Should I consider, no, it doesn't even cross my mind that I should be selling these companies. Now, it's a very different story if I was invested in a company I don't mean to pick on them, but PayPal or something. And over the past year, and I actually used to be invested in PayPal, by the way, but over the past year, I could consistently see, and maybe I'll just pull this up, right? Where the numbers are not really that great. You just take basic revenue growth, and revenue growth has consistently, it was growing at 7-8%, but then as of the most recent quarter, it slid down to 4%. And by this on a quarterly basis, right? So you see stuff like this and you're okay, even if they're able to squeeze out more margin expansion, that type of stuff, best case scenario, they're able to squeeze 10% EPS growth or free cash flow growth, whatever. So you see stuff like this, if you're invested in a company during a downturn like this, and actually a perfect example would be, which I did sell, was Salesforce. I sold it right before the sell-off, and same story. You could see that the fundamentals were deteriorating, and the revenue growth had consistently started to drop 8%, now below 8%. And then they just guided for 6 to 7% revenue growth for Q1 of 2025. So my tolerance for a business that I already wanted to sell in a sell-off like this, that might emotionally impact me a little bit. But these companies where the thesis is rock solid, the fundamentals are absolutely perfect, it's exactly as my expectations were with the business, I have no reason to sell. I have no reason to even think about selling, right? I'm actually excited to buy more at cheaper prices. You look at Google today, and I've tweeted about this so many times. If we pull in something as basic as EV to EBIT, or let's just do PE for now, right? Trailing PE. We're almost at the same valuation it was at the bottom of 2022. At the bottom of 2022, at peak fear, it was trading at about 17-ish PE. Yeah, 17 PE. Currently at about 18 times earnings. Might as well be the cheapest this company has ever been. And if I just toggle on the minimum line here, okay, so I was mistaken. Actually, it traded at, Jesus Christ, 16.5 times earnings. So we have a bit of a fall to get to that cheap of a price, but still, second cheapest the stock has ever been. And like realistically, like you talk about the AI risk and like the LLMs and that type of stuff, and like sure the DOJ might break them up. I think it's more than priced in. You know, the S&P trades at like well above 20 times PE ratio today. So you have a business that's growing significantly faster than the S&P 500, trading at a discount to the S&P. Even if your investment horizon is like, call it the next 3 to 5 years, I would say this is probably a very worthwhile investment. This is actually like at the top of my sort of watch list to continue buying into this business, even though it's a 22% position, right? So just a phenomenal value proposition in my opinion. And so again, like if you take the view like me that this tariff thing is going to eventually blow over, which any macro thing, any war, any whatever in the history, any pandemic, it has always been short term. It's always been, you know, a year, 18 months, whatever. We've obviously had lost decades, which are like very rare in history. And like, again, I just wouldn't take that side of the coin. I think these companies are going to prevail, come out the other side. And like the valuations are cheap. You even look at like, for example, Amazon. So this company, you look at price to operating cash flow, cheapest price to operating cash flow in a decade, like ever, probably never been this cheap. You look at Uber, another company I'm very interested in possibly adding more to. And we pull in price to free cash flow. We're going to have to zoom in on this one just because they were unprofitable for a number of years. But like, look at this. We're almost at the same valuation that it was back at the start of the year when it was at $60 a share, right? So it's just so unbelievably cheap. And so to kind of close off this video, in terms of what I'm going to be doing kind of amid the sell-off, like I haven't done anything. So I haven't bought or sold anything. I talked about possibly selling MasterCard just because it's technically the most expensive company in my portfolio. And then at the same time, it was holding on to its value the best. I'm saying like, okay, like, you know, you have MasterCard at a 37 PE versus Google at 14 times and declining. It's actually cheaper now. It's like 13 and a half times forward operating income. That's a very massive opportunity cost between the two. I think at current prices, I wouldn't be surprised over the next 2-3 years, Google doubles the performance of MasterCard, just purely off of the valuation gets re-rated to above a 20 times EV to EBIT. I'm not banking on that, but I'm saying like very easily that could happen. Gets re-rated to 20 times EV to EBIT. Obviously, Google grows a little bit faster than MasterCard as well, but like it just ultimately we're investors for what reason? To make money, right? And sure, MasterCard is definitely a higher quality business. I'm not discounting that. It's definitely more predictable, that's for sure. But like, it's not like I'm selling MasterCard to buy into like Crocs. I'm still in a very high quality business that I have a lot of conviction in. I understand it very well, that type of stuff. So I don't know. I was talking about that. Haven't done anything yet. Probably wouldn't do anything. I also have a little bit of cash. This is a little bit more now. It's about a 2.5% cash position. And then I should be getting a big lump sum of cash sometime later this week. So I have a little bit of bulk income for the past couple of months that's going to be hitting my account pretty soon. So I should be able to allocate a good portion of that into stocks. But yeah, there you have it. To kind of summarize, I've lost a lot of money year to date. Truthfully, very unemotional about it. And I'm actually very excited to continue to buy into all these companies that I have in my portfolio. And by the way, this website we've been using all video long, finchat.io, you can actually get 2 weeks of it free, no card required. There's literally no catch. You just go to the description, click the link, and you could try the entire platform, the charting, the portfolio tracker, all that type of stuff, completely for free. There's literally no catch, and you can get a 2-week free trial for the higher tier subscription if you'd like. But yeah, thank you for watching and have a great day.